Do you have FOMO from all your friends telling you how much money they're making in dividends while you sit with a stock that doesn't pay a dividend? Or maybe your stock that you've been looking to get into has ran up a couple of dollars and you want to buy it, but it's just gotten a little expensive. Well, I got a solution for you because today I'm going to break down my two favorite trading options: selling covered calls and selling puts. For a covered call, I basically means I have to have 100 shares of that stock in order to place one contract. What I do is I like to look at what the option prices are out there. And in this case, let's look at Enphase. Since my average cost of Enphase is actually higher than what it's currently trading at, I need to look out a little further to make sure that I get a good premium. When I looked ahead, actually on Friday, there's something in the $40 range that gives me like $7. You're going to see that here in a second. How the covered call works is I basically am saying I will give 100 shares up for one contract to sell that stock at the expiration date, which is this Friday, if the stock reaches that price. If the stock doesn't reach the $40 price, the option expires worthless. I keep the premium and my stock. If the stock goes to $40 or $50, I have to sell the stock at $40 plus keep my premium. So it makes sense to do this because I will sell the stock at a price that I already would have sold anyway. For the cash secured put, I'm actually taking money collateral and I'm saying I will buy the stock at a lower price. For this one, we're actually looking at Rocket Mortgage and I'm looking at a $20 to $21 entry fee. I used to have covered calls, but they got called away. So when I'm looking at a stock that's trading 23 plus dollars right now, and I'm trying to get back in at 20 to $21, I'm going to basically put up my collateral at that amount, and I'm going to say I will buy it if it gets back to here. If the stock falls to the strike price that I'm looking at, I will own those shares. My collateral will convert, and I will buy those shares. If the stock went to zero, I would lose all my collateral because I would have bought those shares at what I said I would buy them for, and then everything down below that would go away. However, if the stock doesn't hit that price, I just keep the premium, I keep my collateral, and the option expires worthless. And then next week I do it again. I do these two strategies over and over, week after week, and I take the money that I get from the premium and I put it back towards the stock. So if I got a $5 or $10 or $15 premium, I'm going to turn around and buy $5, $10, $15 worth of that stock and give me a bigger position in that stock. Hopefully that makes sense. These screenshots will hopefully reinforce that. So we're going to do my two favorite options here. The first one I'm going to do solo covered calls. So we're looking at Enphase. We see our average is 35.62. It's currently selling at 34.96. So we're a little underwater here. But let me show you how I do this and how I bring my dollar cost average down. So what we're looking to do here, we're going to sell calls, which basically means in the future, and we'll go with Friday, in the future, if that stock hits the strike price, then I have to sell the stocks at that price, which is what happened at Rocket when we'll get to that one here in a second. Looking at this though, it looks like there's an anomaly here at $40. So, again, we make $5 on this for 100 shares. We're good with that. We'll take the $5 strike price of $40. We'll take the $5 premium. We'll sell it. Robinhood takes theirs. We get $4.96 out of that. With that $4.96, we're going to turn around and buy $4.96 worth of Enphase, which will lower our cost average down. That's how I do sell covered calls. In this next one, this is Rocket. So I actually had my calls called away. Rocket climbed pretty fast. Hit 23 on Friday, and I got them called away. So I don't have a full 100 here. So now I want to buy back in at a lower price. So we're currently 18.59. We're setting pretty nice, but 23.24 is a little pricey right now. Maybe I like Enphase. Maybe I like Rocket. But Rocket's kind of ran a little bit, so I'm not looking to pay that kind of price. We're looking over the years. You can kind of see what it's going here. So here I'm actually going to do the put, and I'm going to sell the put. So I'm going to cash secured put. Cash secured selling of my put, meaning I have to put up collateral for this. But, if it's trading $23, maybe I want to try to get it for $20.50 or $20 even here. We got the right date. Everything looks good. This one's at $7. Robinhood takes theirs. I'm just going to turn around and reinvest that $6.96. I'm going to go ahead and do this. I could do $21 and get 13. But let's just go with the 2050. I think that's just a little more likely, probably not going to happen. But again, I'm going to put this out there, telling me I got to do this. I got to put the collateral out there.
Everything looks good. So I am putting the collateral out there, and I'm probably going to execute on this one. And when I execute on this one, boom, there it is. And I'm going to turn around. I'm going to take that premium and I'm going to buy more shares of Rocket while they hold on to my collateral. When the contract expires, if it hits that price, I'm going to end up with those shares. So it's going to take my collateral and it's going to buy those shares. If it doesn't, I just get the premium and we move on.
Those are two examples on how I do it in Robinhood. I sell those options and then I turn around and I actually buy the actual stock. So I'm always making money. On Rocket, my covered calls actually got called and it got called away, meaning I sold those shares. So I don't want to buy them back at what it's trading at now because I sold it at that, which means I want to get back in at a cheaper price. So I use that strategy that you just saw. And look, I know a lot of people are down on Robinhood. It's a legit broker firm. It's not really much different than Charles Schwab or Fidelity or M1 or any of those other ones. I actually like it. However, it does kind of promote and feel like a little bit of gambling. It's really, really easy to sell and buy stock. It is super easy to use margin and it is super easy to trade options. If you don't understand these things, there's a lot that could go wrong. I'm no financial advisor. I'm just sharing with you how I use these options to keep growing my portfolio. And because Robinhood makes it so easy, you have to make sure you know what you're doing, do your own due diligence, and don't just swipe because it's quick and easy to do. And with the market like it is, I really am not a fan of margin. I do know that if you're a gold member, you pay the $5 a month, you get $1,000 of margin for free. But even then, I'd probably be very careful about using it. So while I think Enphase and Rocket have potential, do your own due diligence. Those fit my risk tolerance. They may not fit your risk tolerance. Please do your own due diligence. I am not a financial advisor. Hopefully you're a little more familiar with my two favorite option strategies and how I use them. If you don't have a Robinhood account, click on that referral down below and you can get $500 to $200 worth of stock for free just by activating an account and depositing money. If you got anything out of this video, I ask that you share, like, and subscribe. Comment down below. Stick around, we're going to do amazing things.